Revenue expenditures asterisk refer to the costs incurred by a business that are necessary for maintaining its day-to-day operations. These expenditures are typically short-term in nature, do not result in the acquisition of long-term assets, and are deducted from income in the period in which they are incurred. They are also referred to as operating expenses. Here's a breakdown of revenue expenditures in more detail. Number # key characteristics of revenue expenditures. 1. Short-term impact. These expenditures are used up within the current accounting period. They do not result in the creation of long-term assets. 2. Expense nature revenue. Expenditures are treated as expenses and are deducted from the revenue in the same period. 3. Non-capital. These costs are not added to the value of assets, but are expensed in the period they occur. 4. Maintenance of operations. They are incurred to maintain the regular business operations, such as paying for utilities, wages, rent, and materials used in production. Examples of revenue expenditures: 1. Salaries and wages. Payments to employees for their services. 2. Rent, costs of leasing office space, machinery, or other assets. 3. Utilities. Payments for electricity, water, and other essential services required for operations. 4. Raw materials. Expenses for purchasing materials used in manufacturing or providing services. 5. Repairs and maintenance. Costs associated with maintaining and repairing machinery, equipment, or property to keep them operational. 6. Advertising and marketing expenditures related to promoting the business or its products. 7. Supplies and consumables, office supplies, or any other consumable goods used in business operations. 8. Insurance costs for business insurance policies to protect the company against various risks. 9. Depreciation. The annual allocation of the cost of assets that are used in the day-to-day operations. 10. Interest payments on loans or borrowings that are necessary for operating the business. Financial reporting. Income statement ***. Revenue expenditures are reported on the income statement because they directly affect a company's profitability. These expenses are subtracted from the revenue to determine the profit for the period. Difference from capital expenditures, revenue expenditures ***, focused on day-to-day operations and are expensed in the current period. Capital expenditures focus on purchasing or improving long-term assets like buildings, machinery, or equipment, and are capitalized and depreciated over time. Why revenue expenditures matter? 1. Profitability impact. Since these expenditures reduce the company's income in the current period, they directly affect profitability. 2. Cash flow management. Proper management of revenue expenditures is essential to maintain positive cash flow. Excessive spending can lead to cash shortages. 3. Tax implications. Revenue expenditures are typically deductible for tax purposes, which can reduce the company's taxable income. In summary, revenue expenditures are the necessary operating expenses of a business that help maintain and support the ongoing operations, but do result in the acquisition of long-term assets. They're key to keeping the business running smoothly and must be carefully monitored to maintain profitability